Hi everyone, this is Vineela from Indigolan. Today I came with a different topic so that I can make your concepts clear. So this concept relates to macroeconomics part of your business and technology paper. This topic is balance of payments. This topic is very important from your examination perspective as well as this is important to make sure that your concepts are clear in this concept. So some people will get confused in this concept. There are minor confusions only. This concept is easier as well as a scoring one. Let's move into the topic. So let's start with the topic balance of payments. See, this topic is important from your examination point of view. Make sure you remember that. I don't say there will be a huge number of questions, but from the whole chapter of micro and macroeconomics, good amount of questions will come in the exam. So let's start with discussing about balance of payments. See, balance of payments is a macroeconomics concept. So first of all, what is this balance of payments? See the definition that was given in your textbook. A country's balance of payments records all the financial transactions. See, this word is important, financial transaction, and that too all financial transactions made between individuals, businesses and its government with foreign consumers and organizations. So understand it is in a wholesome covering all the people that were involved and those people who are doing business with the other countries. It is not just individuals or not just businesses. It includes government also. So all the financial transactions that are made by individuals, businesses, and the government of that country with foreign consumers and organization. So make sure you are understanding that balance of payment has the financial transactions. It covers financial transactions, that to all the financial transactions that are made between individuals, businesses, and its government with foreign consumers and organizations. So let's take a small example for this concept. Example for this concept. See, let's take our country India, and let's take Mr. X is living in India, and he's a sole proprietor. Assume he does business of selling clothes. So he wants to sell these clothes with foreign customers who are there in US. So what it is he is selling goods to the people who are living in US, and he is getting some profit from that sale. So the sale of goods and getting profit is nothing but a financial transaction. So business that was made by Mr. X, who belongs to India, with a person who is there in the country USA. So the transaction between these two people will be a financial transaction, and it will comes under balance of payments of our country. So all the financial transactions that were made by Mr. X with a foreign country, not only just USA, any foreign country, it will form part of your balance of payments. Just take an example, Tata Motors, Infosys, they're doing any business with any foreign client, that will come under balance of payments. And government doing any business with foreign consumers and foreign organizations, that too comes under balance of payments. That's why he's simply using a word. Just highlight this word, all financial transactions made between individuals, businesses, and its government with foreign consumers and organizations. So the home country doing some financial transactions with foreign country, that can be between the home country. Individuals can do business with an individual, can be with individual with another business, an individual with government, or businesses same doing with individuals, business, and government doing with individuals, business, and anything can happen. Anyone can do business with anyone, but it has to be between a home country person and a foreign country person. Then it will form part of your balance of payments. Now there was a misconception that I have seen among students, that they assume that balance of payments is nothing but balance of trade, but it is absolutely false. It is a wrong statement. That is a misconception. It's a myth. Understand, balance of payments is split into three parts. One is current account, capital account, and financial account. So, ma'am, so what is this balance of trade then? Okay, fine. You said that balance of payments is not balance of trade. So then what is this balance of trade? This balance of trade is nothing but your current account, which is a part of your balance of payments. So understand, balance of trade is a part of balance of payments. So balance of payments is a huger concept compared to balance of trade. Balance of payments consists of balance of trade, consists of capital account, consists of financial account also. So this is a part. So balance of trade is a part of balance of payment. I hope this is a point which you have to make clear. So let's see. As I have said you, balance of payment is split into three parts. One is current account, another one is capital account, and the third one is financial account. So what consists of this current account? See, what is current? Nothing but that goes on in a day-to-day like a day-to-day activities or operation activity. So current account is nothing but the speaks from the perspective of goods and services. So what are these goods and services? See, there are two concepts you have to understand here: import of goods and services, export of goods and services. So Mr. X from India is selling goods to Mr. Y of UK. So what that is? Mr. X of India is selling goods to Mr. Y of UK. That means goods are moving from India to UK. Then what it is? Whether it is an import or export. So that will be export. You are exporting goods to UK. That means Mr. X of India is sending goods to UK. The one which has becoming export for X will become import for Y. The vice versa. So take the other concept here. The same thing, but what is happening is Y is selling goods to X. It is not that X is selling goods to Y. Y is selling goods to X, or you can assume that X is purchasing goods from Y. X is purchasing goods from Y. So when a person from India is purchasing goods from a person from UK, then it will be called as importing. I am importing goods from UK. Understand? Export, you are sending goods from your country. Import, you are bringing goods from other country. So import or export can happen either in the form of goods or either it can be happen in the form of services. So this combination of import and export of goods and services with people in foreign country by the people in home country will be form part of your current account. So daily sales and sales will happen. Daily purchase will happen. That means nothing but daily the imports and export will happen between our home country and foreign country. So that's why it will form part of your current account. So coming into the next point or the next part, capital account. So capital account is, yeah, I think you people know from your financial accounting or paper that something but capital expenditure. It is nothing but your assets or liabilities that will be there for a longer time period. So same thing here. See, the same thing, there was change in ownership of assets or loans that is made between the government and other countries. There any change in the ownership of the foreign assets or any such loans between the government and other countries, all that will come under current account. See, these were not of short time period. The short time period of sales and purchase in the form of imports and exports are already covered in current account. So the long-term perspective, the assets, loans, that will come under capital account. Next one is financial account, cash flows. The cash coming in, the cash coming out, the US dollars coming in the country, the rupees that were going out of the country. Anything that in the form of cash flows will come under your financial account. So make sure understand balance of payment is divided into three types. The first one is current account, which deals with respect to imports and exports of goods and services. Second one is capital account, which speaks about the foreign assets or loans by the government with other countries. The third one is financial account, the cash inflows and outflows. So see this misconception. That's what I'm speaking that was mentioned here. Often when people talk about balance of payments, they are just referring to the surplus or deficit on imports and exports, that is current account. But understand, the balance of payments is not just current account, it's a combination of current account, capital account, and financial account. So there were other two words that you have to be aware of now. One word is deficit and the other word is surplus. So India is importing more goods than exports. That means imports are greater than exports. I'm importing more but exporting less. The other point is I'm importing less and exporting more. That means imports are less than exports. So if you are importing more, then it will be called as deficit. If you are exporting more, then it will be called as surplus. Why, ma'am? Why it is deficit and why it is surplus is, see, if you are importing goods, what happens? You have to pay cash for them. As you are purchasing goods, the cash, you have to pay them in cash. Assume that you are paying in dollars. So when you are importing more and more goods, the amount, the rupees were going out of the country, but the same amount, the same rupees is coming into the country in the form of exports. No, they are not coming because your exports are less compared to your imports. That's why I'll say that it is a deficit state for the country. The same goes to surplus. You are importing less compared to your exports. Now, the amount of rupee that was going out of the country is less compared to the dollars that were coming into the country. So dollars are coming more. That's why I'll be in the state of surplus. I hope these two words are also clear with you, deficit and surplus. So as this relates to sale and purchase of goods and services, sale and purchase is nothing but trade. You will call them as either trade deficit or trade surplus. If the country's import exceeds exports, that means imports are more than exports, it is known as trade deficit. If export exceeds import, that means nothing but exports are greater than imports, or I'll write that imports are less than exports. It is nothing but your trade surplus. Let me summarize what I have explained you now in just few seconds. See, there's a concept called balance of payments. Balance of payments consists of all the financial transactions that were made by individuals, business, and government of one country with the foreign country, either people, government, or organization, anyone in the foreign country. These balance of payments were of three types. One is current account, capital account, and financial account. Current account deals with import and export of goods and services. Capital account deals with ownership of foreign assets and any loans with any loans. And financial account deals with cash flows, either inflow or outflow. So the point you have to make clear is balance of trade is a part of balance of payment. Balance of payment is a huger concept compared to balance of trade. And the other one that you have to understand is trade deficit, trade surplus. Trade deficit is nothing but your imports are more than your exports. Trade surplus is nothing but your imports are less than your exports. Or I can simply say that your exports are more compared to your imports. So you have to question yourself that, so what is better for the country, whether trade deficit or trade surplus? Just think whether trade deficit is good for the country or trade surplus is good for the country. Many of my students always say that when I ask this question to them, they immediately say that, ma'am, trade surplus is good for the country, because they assume that always surplus is benefit. See, net profit, gross profit, always they're also surplus. They feel that net profit or net loss is a benefit for a company. So in the same way, trade surplus is also benefit for the country. But this is where you have to think with a clear mind. I don't say that either trade deficit is good for the country or trade surplus is good for the country. Let me explain you more clearly. See this point here. Generally, governments would like to avoid long-term balance of payment, surplus or deficit. See this point. Either I don't want long-term surplus trade deficit or long-term surplus or long-term deficit. Either from the balance of trade point of view or balance of payments point of view, I don't want long-term surplus or deficit. He is clearly saying they will avoid surplus or deficit. They are avoiding surplus as well as they are avoiding deficit. Trade deficit is not good for the country. Trade surplus is not good for the country. So, ma'am, how? Okay, we understood that trade deficit is not good for the country because there is more outflow of our rupee than inflow of foreign currency. That's fine. We are clear with that concept. So, but ma'am, why the trade surplus is not good for the country? That's where the important part comes. See, I know you clearly know why trade deficit is not good for the country, but just let me give a reading for this. Trade deficit means that there's a net outflow of cash. Of course, there will be net outflow only because there is no inflow, because more rupee is going out, less dollars are coming in. That's why there will be net outflow of cash from India. In the long term, this is clearly not supportable. Of course, this will not be supportable because when more rupees are going out, our results will drain out, our assets will drain out. If more money is going out, our credit rating will also be reduced. When our credit rating will get impacted. If your credit rating gets impacted, what is the main thing that happens to country? It will be difficult for the country to obtain any international loans from international financiers or international banks. So that is how the great impact will be there. So simply, you'll be having for your CIBIL score. If your CIBIL score is affected, then it will be very hard for the people to get loans, get your personal loan or any loan from the bank. The same way, country will also have a credit rating in the world. So if that credit rating is affected, it will be difficult for the country to raise further finances. So that's why trade deficit is not correct for the country, or it is not suitable for any country, because it will drain our resources, it will drain our reserves, and it will impact our credit rating, and which will make our country difficult to raise finances. So, okay, fine. So, what about this trade surplus? See, simple thing. More dollars are coming into India. As more dollars are coming into India, country will become wealthy. As country becomes wealthy, demand increases. Demand for the goods increases. When demand increases, assume that your supply remained constant. Assume that your supply remained constant. Demand is increasing, supply is remained constant. There is no increase in supply. Then what happens? In order to reduce the demand, what the organizations or businessmen will do? They'll increase the prices. So increase in the price of the country is nothing but inflation. So because of trade surplus, there will be a rise in inflation, or there will be impact of inflation in the country. So let me make this more clear again. I am saying that from trade surplus, you will have more exports. When you are exporting more than imports, more dollars will come into the country. Dollars are increasing in India. As dollars are increasing, the country will become wealthy. As the country is becoming wealthier, what happens? People demand for more goods and surplus, goods and services. Of course, when I have more goods in my hand, of course, I'll purchase more dresses and more things for my sake. So that's why I'm demanding more goods and services. So as the demand is increasing, but when the supply remains constant in the country, because as the demand has automatically got increased, doesn't mean that I can increase my supply immediately. No, it is not possible. As the supplies remained constant, as a businessman could not meet this demand, they will start raising the prices. A simple thing, rise in price level in the country is nothing but inflation. So this is the reason why the country is not supposed to have either trade surplus also for a longer period of time. So either surplus or deficit for a longer period of time is not supported for any country. So this is a concept of balance of payments. So in order to make sure your balance of payments are in a proper state in the country, there were two strategies that was proposed. Let's see those strategies also. They are nothing but expenditure switching strategy, expenditure reducing strategy. So through that strategy, you can make sure that your balance of payments are intact, that does not affect your economy. So this is what I'm speaking about. Balance of payments. See here, if the country has a deficit on its balance of payments, there is net outflow of funds from the country. This is what we have seen earlier. When there is a deficit, there will be net outflow of cash. When there is a surplus, there will be net inflow of cash. This is clearly not supportable in the long term. As a country will run out of money, our reserves will go off, our cash reserves will go, our assets will be converted into cash, and we'll be giving that cash also out of the country. Everything will be ruined in the country because of the deficit state. The government can therefore look to reduce the deficit using either expenditure reducing or expenditure switching strategies. So as a deficit is clearly not good for the economy, what government will try to do here? the government will either follow expenditure reducing strategy or expenditure switching strategy. So let's make these two concepts clear. What is this expenditure reducing strategy? See, the word itself is making the things clear for you. Expenditure reducing. That means through this strategy, I am trying to reduce expenditure in the country. So how that happens? These involve the government deliberately shrinking the domestic economy in order to reduce the demand for imports. That means I myself reducing my domestic economy so that I could, as my economy is getting reduced, what happens? My purchasing power will get reduced so that I will not import more goods. As purchasing power is reducing, imports will also be reduced. As doesn't have that purchasing power, I could not pay money for those goods. I'll not demand those goods from the outside country. So how you can reduce the demand for imports? How you can shrink your own domestic economy? The one is contracting monetary policy. What is this contracting monetary policy? Is either you will increase your interest rates or you will increase bank reserve requirements. So what this is a different concept that relates to monetary policy, but as we are here, let me explain this concept also. See, assume bank on 1st January 2022 and 1st January 2023. The interest rate to get a loan from a bank is assume that it is 10%. And what they have done is on 2023, they have increased this interest rate to 18%. So at 10%, there are around 2 lakh people who have taken loans. Those who are ready to pay 10% or those who are able to pay 10% of interest. But assume, will there be same number of people who will be taking loan in 2023 at 18% of interest? No. There will be some people who will not be able to afford this 18% rate of interest. Then people taking loan will get reduced. Assume that here only 1 lakh people have taken loan. Each has taken, so 2 lakh people and 1 lakh people were there. Here in 2022, 2 lakh people have taken loan. That means there was a huge outflow of cash from the bank to people where people can demand more goods. But in 2023, only 1 lakh people have taken loan. The demand for the goods will be only from 1 lakh people. So in 2022, the demand for the goods is more. And 2020, demand for the goods has reduced. So that is what he is saying. Deliberately, you are trying to shrink your domestic economy by reducing the demand for imports. How you have reduced the demand? By increasing the interest rate for loans. People who doesn't want to take loans for importing or for their business purpose also, they will not be able to take loans now, because in 2023, 18% is the interest rate where it is not affordable for them. That is a one strategy they are following. So what can be the other strategy? Bank reserve requirements. Assume that RBI has said to all the banks that they have to maintain, in 2022 notification, they have said that you have to maintain 20%. Assume this is just an example, 20% of amount as reserves and remaining amount can only be given as loan. And in 2023, it has said that 40% amount has to be kept as reserves. So assume that we have 1 crore with the bank. Now, how much amount bank can give as a loan? 20% they have to put reserve as in the bank itself, and remaining 80 lakhs can be given as loan. But in 2023, they can give only 60 lakhs. See how the money outflow that is going from bank to outside economy is getting reduced. There is a reduction of 20 lakhs. That means 20 lakhs of value of imports will also be reduced. So this is how you will try to reduce expenditure by shrinking your own economy by either increasing your interest rates or either increasing the bank reserve requirements. The another thing you can do is running budget surplus. So this is what the other concept where you run your budget at a surplus so that domestic economy will get reduced. Budget surplus is nothing but your expenditure will be less than your income. Government, that is not your expenditure, government's expenditure will be less than government's income. So this state will be called budget surplus, where government is not ready to expend more. That means the amount will be very less. That will be what you call it as, that will be imparted into the economy. Assume that my expenditure is 1 lakh, but the government's income is 2 lakhs. That means they have a possibility of expending 1 lakh more, but they restricted themselves to only 1 lakh. That means outflow of money from government is also reducing, where the money will not flow to the individuals of the country, and they will not purchase goods. That means how they will do this is they'll reduce subsidies. They'll be not providing any grants to the businesses. Like that, they'll be reducing their expenditure, where the outflow of the money into the economy will got reduced, and also where the people will not demand. Reducing the size of economy will also help to reduce inflation. Of course, when the flow of money is reducing, demand will reduce, and the as demand is reduced, now the prices will be reduced. As the price is reduced, there will be reduction in inflation, reducing export prices and making the country exports more competitive. So what happens here? You'll reduce export prices. The goods which you are exporting, the price will be reduced. Now the people will purchase more of your good from the other countries as export prices are less. Now that means that your exports will get increased. Now your imports will be less. That means you are turning into a state from trade of deficit to trade surplus. However, suppressing demand is likely to lead to the increased unemployment. Of course, it happens when I'm not producing more goods, or when I'm suppressing the demand. What happens? Business people does not need more people for the labor. So what happens? They'll be removed from their employment. This is a main thing that happened in the COVID situation, where in the COVID situation, the many businesses have closed their work, closed their production, where there's no need of labor. They were labor from removed from their jobs. There's unemployment situation, as a business have no demand for their goods and services. The best example for this is your COVID. This is what happened in the COVID. Next strategy which you have is expenditure switching strategy. See, you're switching the way you are expending the money. These involve government trying to encourage consumers to buy domestically produced rather than imported goods. Understand this. That is what you call it as made in India. Startups, where we are encouraging startups to establish their business in India. That means there will be more goods from India, so people will not have any need to purchase goods from outside the country. When you are not purchasing goods from outside the country, that means your imports will be reduced. So that is what your expenditures, which they are saying that you are allowed to expend, but don't expect on imported goods. Try to expend on domestic goods, so that our economy will get increased. If you purchase imported goods, what happens? The country from which you are purchasing those goods, their economy will get increased. So rather than improving their economy, the government is trying to say that improve your own economy by purchasing your own domestic goods. So how this could be accomplished? This could be accomplished by controls on imports via tariffs or quotas. That means simply what I will do is I'll increase the import tax. That is nothing but your customs duty. Customs duty will be increased. As a customs duty is increased, import prices will increase. As imported prices are increased, people will move towards domestic goods. Increasing exports by subsidizing exporters. That means I'll provide more subsidies to our exports. I'll reduce the taxes for exports, so that export price will reduce and more people will purchase from the other country, will purchase my goods. That means indirectly, I'm trying to reduce my imports and I'm encouraging my exports. And the other thing what you will do is lowering the exchange rate. That means you are trying to reduce your rupee value. As a rupee value got reduced, the outside people will purchase more of your goods with the less value of your rupee. Before $1, assume that $1 is nothing but your 80 rupees. Assume that now rupee value has decreased and it has become 100. So outside country can at 80, if a person has purchased 4 units, now he will be purchasing 5 units, because dollar value has increased and the rupee value has decreased. Where we are trying to do it intentionally, so that our imports will be reduced and exports will be increased. Now for us, the goods that were there in the dollars, that was goods that were from USA, which was valued at dollars, will become costlier for us. So we will not able to purchase them. But for the other country people, our goods will become cheaper. So this is nothing but called currency devaluation. Currency devaluation. You are decreasing the value of your own currency. But this is not good for the economy. We should not do that. We should try to follow other strategies only, unless it become a situation where we can't reduce our trade deficit. Unless we follow currency devaluation, we can go for that, but it's an extreme measure by the government. No way government will choose devaluation unless there was an extraordinary situation. So this is what the whole concept about balance of payments and the strategies that will reduce your trade deficit in the countries. Nothing but your expenditure switching and expenditure reducing. Balance of payments, current account, capital account, and financial account. Current account is nothing but balance of payments. Trade deficit. Yes. Trade deficit is where your imports are more than your exports. Trade surplus is nothing but your imports are less than your exports. Both the scenarios are not good for the economy for a longer, if they are staying for a longer period of time. So this is what the whole concept about balance of payments. I hope this concept is clear. One thing I want to make sure through this video is, so those people who are seeing these videos, if you have any concepts that were unclear, you want me to make those concepts clear, make sure you give a comment in the comment section so that I'll come with that topic in the next session so that I can teach you the topics which were difficult for you. Thank you, everyone.